And John Davies,
Pleasure, Coach.
really looking forward to meeting you and speaking with you. I've now made you the presenter so we could hear you. And if you have anything you want to show, there's a screen share option. And we could talk a little bit about your journey and what you think of current market structure, especially, with what happened yesterday with all these raids in the FX market. So,
well, I think right now you have to, and I suppose you might, if you read anything, what I believe in, I'm very much a long-term investor.
Okay, John. So, are you? You're a little soft.
Can you hear me?
But do you want to show your setup? There is a screen share option, or no? It's optional.
No, it actually doesn't look like it's possible. I'm trying to show it, and it looks like it keeps flipping. So I'm not positive, but
yeah, it's just a drop down where it says share screen, and then you choose which screen.
I'm trying to do it right now, and it's not really having much luck presenting. No, can you hear me better now?
I can hear you better now. Yes.
What I was saying is, I'm more of a long game investor who looks at distressed situations. Now, when I say long game, I'm looking at a long game presentation, a long game investment strategy, predominantly and I have been for many years, predominantly commodities based. But when I say long game, I have to go through the short term with that. And with that strategy, and with my strategies I've talked about, is risk management comes first. And within my goals, I might take a slightly different different approach than others. My goal is to significantly reduce the cost of my equity investments through option positions. So I'm looking at situations that I believe in very strongly. I mean, I happened to step onto your show yesterday when we were talking about copper, which is obviously the bellwether, and everyone wants to really, as we were showing concerns over copper, which is only natural. We're looking at
there it is, John.
We're looking at a potential, whether or not we've got that. Whether we're testing that support of early September, and whether or not we've got a breakdown from 264 down to the 240 ranges. Now, in those situations, my belief is in long term, and I guess there's some pretty valued investors, pretty important investors who share the same thing of looking at Freeport, FCX. Within my goals, I look at a strategy with options that radically reduces the investment of that within my goal is within 30 months to pay down the entire cost of the investment, assuming a person has a long equity position. So what you're then looking at.
How do you do that? You write calls to
you're going to look at a few different situations, and let's just take a look at.
There's Freeport. I put it up for you if you want to talk.
Yeah. Okay. So there's a beautiful situation, Freeport, right? You're looking at a company trading at a tremendously low price in comparative historical, right? And whether or not I would look at legging in. And I don't know if the gentleman, if you had mentioned this yesterday, I think someone did on incremental buying positions. And I look at legging in. And in a market like this, I like to leg in either 1/3 or 1/4 positions. So I will be looking at, and it depends on the premium, of garnering a premium of any situation of upwards of 1.5% a week within a covered call position. So you're going to look at the weeklies, and that breaks you down to a lot of different things, different equities. But Freeport is obviously the best example of copper. And then you're going to be rolling in your position where you have a cascading series of puts. You're writing a cascading series of puts. Now, that allows you a lower accumulation. And with someone like Freeport, or whether or not you're looking at you're mentioning gold, if you're looking at precious metals, if you're looking at Barrick, the new Barrick Rheingold, or you're looking at in silver, let's say First Majestic or Fortuna, it allows you to say, okay, I'm defining my investment cost at this time. Maybe it'd be 10,000, maybe it'd be 50,000, whatever it might be, and I'm dividing into incremental positions. And within that, I'm gradually and systematically reducing the cost. Now, the goal has to be that you want to drive in you want to drive in approximately 1.5% per week of the original book cost. And in so doing, and at that time, any of the extra premium up to 1/2 of that, you're adding for additional portfolio insurance, maybe a long put position. But at the similar time, as if you're doing that, you might be putting in a put, putting in a bear put spread, where you might also be writing puts in the event that it's going to drop. So we're looking at a very systematic approach to portfolio acquisition. Now, I know that seems that might be a little bit odd in today's market, from what I read at least.
Well, I just think it might be a little complicated for viewers to know. Well, just to know when to put these on, and and how you manage risk when you're writing options. And that may be from both writing puts and calls. Does that help you with risk management?
Well, it certainly does. Well, when you're writing a put, that's a different thing. Of course, that is the only difference when writing a put is you're defining where you're going to accumulate the price, accumulate the equity. Like, for instance, I just mentioned today on Twitter, and I know a lot of people are going to be going out and bottom fishing, are thinking of bottom fishing Apple today. And I know that's going to be the big celebrity today of bottom fishing. And I hope that they think of, okay, so if I'm going to do that, where am I going to look to acquire? Am I going to be looking at acquiring at 145? Well, sure, if you like it at 145, will you like it at 120? So maybe you're.
So you select a strike price and write the put, precisely. And then if it goes to that level, you're prepared to buy it at that lower cost.
And the overwhelming majority of these are never going to happen. When you're writing. I mean, look at if we jump back to Freeport, we're looking at a 1036 closing. How would a person like to be looking at? We're going out a little bit farther. We're looking at maybe the 950. We should, we're obviously going to get a little bit of weakness today. But if you start looking at those 950s, as far as writing, there's no reason a person can't come in and say, you know what, I'm going to go out there and I like the situation. I've looked at the fundamentals, right? I'm one of those old boring guys who likes fundamentals. Maybe you've done your analysis. You've looked at the enterprise value. You want to target those enterprise values that are really, really strong, like that under seven. And then you say, well, what I'm going to do is I'm going to go out and aggressively, I'm not going to go out there and say, write a deep or a far out of the money call. I'm going to write it at the money call, or even in some situations, if the premium is sufficient, then in the money call, you just scalp there. Once you look at your commission, if it's sufficient, you say, what I really want is 1.5% a week. That 1.5% a week really adds up. But like something like Freeport, if you're going in, and let's say you're going in a 1/3 incremental position, maybe you're going to look at the near term. Okay, I'd like it at approximately 1050, but I'm only going to take 1/3, and I'm going to, just come in under the 1050 mark. I'm at 1036. I'm going to write the 1050 calls, but maybe I'm going to look at writing those 950 puts, a little, those 950 puts, right? And maybe I'll look at and now what I've done is at that situation, 1/3, I've immediately reduced the cost a little more. You're using that premium to pay for it, and you're bringing it down. And that's why a cascading series of puts. And cascading means that you have to look at it like a pyramid. So that if you're buying 1 unit at 10, do you buy 1.5 units at 9? Do you buy 2 units at 8? And you bring down, you look at aggressively bring down, but you know how much is going in, how much you got going into this investment, and that you want to, right? Does that make sense?
Well, let me ask you this, John. There's probably some people who thought when we went to 12, halfway back of the whole move, that might have been the time. So how did you discern the 10, which is an interesting area? 1036 is actually 61.8 back of the whole move.
Yeah, no, it is. It's very interesting. It's a very interesting area, and it's also coming. So
how does a fundamentalist discern without technicals discern a price level?
You're going to have to. Yeah,
Go ahead.
that's a good question, because you're going to have to, what you have to go back and forth and say, no fundamental investor can come to the party without understanding technicals, right?
Okay. All
And
right.
you absolutely, you can't just be a pure fundamental investor and say you're going to ignore technicals. And I'll give you the good example of that one.
Jack Schwager says that, John. I interviewed him, and we had this discussion of fundamentals and technicals. And what he said is he prefers technical traders because fundamentalists, when they're wrong and the price gets cheaper, say they're accumulating, they still believe they're right and they're getting it at an even better price, and
Yeah,
it turns into a blow up.
you don't double down. You don't double down on your losers, right?
Yeah, yeah.
You never double down.
Well, I have.
Yeah, well, that's one of that's one of those problems that we all. But see, for me, my goal, like I rarely enter a position. I mean, rarely enter a position. It will be no more than a portion of my portfolio resigned to juniors, where I'm not looking at hedging via options. If I'm not hedging with options, I don't want it. I simply won't.
Okay.
Like, you have to come early to the party. And I'll give you a good example of that is Cameco. Now, I'm bullish on uranium, but I'm getting a little bit squeamish because a lot more people are now bullish on it. So it's getting to be
it's getting a lot of hype on Twitter.
It's getting way too much hype, and I don't like it. But I entered Cameco when it was quite low. I entered Cameco in actually the end of October.
What's the symbol, John?
CCJ. And that's the uranium powerhouse. I entered Cameco at the end of October last year, and it had just taken a nice run up through the past year, and it was approximately $8. It was approximately $8, and the goal was, I believe this is going to go back to its old heydays, and we're going to see this situation move back into, certainly see those lofty periods where it's back into potentially that $25, $30 range. But that's going to take some time, right? That's going to take some time. But in so doing, during that time, I want to write off that cost of investment. Now, at that moment, the options on it were offering tremendous premiums. So what I did basically was, you have to come early to the party. Now, what you've got is Cameco. It's bounced. It's seen $12 in the last year, and it's back down to just under 11 and a half. But when you come in there early, you come in there at $8. Come in there early at $8. You start looking at writing those options. And if you can come out, if you can go out a month and you can get 3.5% on that, you're going to gradually reduce your investment. And the goal is, and all you have to do is look at this as a mathematical thing, is you want to eliminate the cost of investment through the writing of calls and paying for part of the investment through writing of puts at a much lower price. Remember, in that situation, I think I did. If you like, for instance, Freeport today at 10.36, you're probably going to like it at $9 and $9.50. So you look at incrementing part of the trade in that situation. So what you'll do is you'll look to write calls and then say, okay, that's only 1/3 of my position. The other 2/3 of my position, I'm going to cascade down. And if those puts, if the stock, as you certainly wish and you believe, is going to stay up and ascend, you're going to be paying down the cost of your existing position. Now, that's going to mean that you're going to take time to get your accumulated, your target, right? Your target shares, but so be it. You basically reduce the cost of investment. Now, with Cameco, because of that strategy and the way it moved up, I've been able to consistently eliminate my cost of investment for everything in Cameco in roughly 6 to 8 months per section, right, of the portfolio. And that's what I do.
So you own it for free?
You own it for free. And by the way, when do you? And now this is one thing, and I speak almost. It seems like I'm in New York right now, and when I was in Toronto last summer and in London. This is one of the things that I speak to investors all the time, particularly investors who have a dividend section of their portfolio. And I say, well, let's look at this thing. If we are doing this with dividends, pick whatever you'd like, right? Let's not pick GE, but something that you feel good about on it. what's your yield? What's your yield on your investment when it's for free? And
Yeah,
so
interesting.
it's exactly.
It's unlimited.
That's exactly. Now, when you look at, that's exactly it. I mean, it's just infinite and it just keeps growing. You do that with every situation. So, I resign 90% of my portfolio to situations that I can hedge and accumulate and radically, I say accelerate the reduction. Now, accelerate the reduction of paying down the cost of investment. And this is something that every person listening to, because obviously on your show, I've heard a lot of people talking about gold, right? And I think probably one of the most general, correct me if I'm wrong, it seems like we all have the same opinion, or we certainly do. Gold looks tremendous. It's moved well, but boy, that straight up line is kind of uncomfortable, right? Of the last little while. It looks ready for a general easing before another further pop. That's if you're a gold bug, you believe in a pop, right? And certainly we could see that test back down to 1260, and I think we'd all be salivating if we got it back into 1240. Now, if, say, for instance, you believed in equities in that sector, right? You pick out whichever you like, but let's just go with Barrick or Goldcorp, and you'd say, okay, so I want to have exposure to this. Well, if you're thinking of that sector, why don't you define your risk? And then immediately, and you have to work these numbers out on yourself, define your risk, look at what is the profit center or the profit margin that you want. Now, when I pay off an investment in 30 months, you just do the math on that real quick. What you're seeing is, my gosh, you're getting well over 36%. And when you can compound this over and over year after year, it's a heck of an ROI, right?
Who let the dogs out?
That's exactly it. Well, he's
I've had dogs as trading partners through a lot of my career, and when they're laying on their back, they're bearish. On their stomach, they're bullish. So
there you go. Well, he's having some fun right now. He's announcing.
Anyway, he wants you to write some more puts on milk bones.
There you go. I'll have the dog, the milk bone puts. But yeah, it's kind of a funny situation right now. What you can do is that I think investors right now, and again, I've been doing this for 35 years. I think investors right now are so short-term minded that they forget the long term, the long game. And the long game is where you take these investments. You have a great investment, a participation in the economy. They help build the economy. They provide you this extraordinary revenue. But when you use options to radically reduce your risk and then basically pay down the profit, you've really doubled your ROI in a short period of time, relatively short period of time, without this equity really moving a tangible amount. Anything extreme if you use options. But you also, it makes a priority of risk management. This is possible, and maybe this is just the changing of the investment public's approach, tactics of the modern investor. But when you look at using options and you look at scalping, because what I tell people is I don't believe any person can predict a market movement. Everyone thinks they can, but they just can't predict it. Is that every week a market will go up, a market will go down. Some people can predict it perfectly, but every week an option premium decays.
Right. And options, John, options are like relationships. 90% of them expire worthless. But but anyway, those 10% are worth pursuing.
No, they're absolutely
in relationships.
Yeah, you know what? Anyway. It's absolutely true. But here's the thing: is that when investors look at this approach, they can become involved in the bluest of blue chips, whatever it might be, and then they can get involved and radically reduce the cost of anything that they do without significant risk exposure. Where they otherwise might have. And that's something that I really like to see investors take part in. I think this is also an important thing for us to consider of future generations of investors. I don't know if you're familiar, but we really have a problem with
Millennials?
the millennial generation investing. And
They're only paying attention to crypto.
Well, they're barely that.
Hold on, John. I have to put my yellow hard hat on. Go ahead. Now it's on.
It's echoing up. I'm sorry.
All right.
It's one of those things that's happening, and it's a real problem for us. I mean, it goes into that fourth turning philosophy, is that we've got a whole group of investors who are no longer taking part, and I hate to see what happens. Well, we all start to retire, right? And when we retire, when we start looking at pension funds and whining, because we've just got a group of people that are, no longer in the marketplace.
Yeah, that's the Harry Dent demographic bearish argument about baby boomers retiring, who's going to come in, and they'll be selling stocks.
Well, that was written up. Yeah, that was written up years ago. You know, the gentleman who wrote The Fourth Generation. Now, I think what that is going to create is it's honestly just going to create market opportunities for fundamentalists. But what I'd like to see is a whole generation. This is one of the things that I'm dedicating much of the balance of my career to, is getting a whole generation of investors not being scared off by the market, but realizing how simple gains can be. I'll give you a great example. A funny story was around 2 years ago, I bought a new house. And when I bought the house, and I think the financing, the mortgage rates were 2.3% approximately, right? And I asked my banker, and I said, well, I'd like a mortgage on this. They said, Mr. Davies, why are you asking for a mortgage on this? It's and I said, because I'm taking the mortgage up at 2.3%. I'm buying your bank stock, which has a yield of 6.5. I'm writing covered calls on it and buying puts. I'm going to really triple my money on the money you're giving me on your stock. And that's how I'd just like to see investors come in there, because we've got some, right now people will talk a great deal about how the markets are overvalued in certain sectors. But let me tell you, the mining sector is not overvalued. Oh, yes. So the mining sector is beaten down. And the mining sector, I hate to tell people, you're not going to be worried about the mobile phones and technology if you don't have enough copper or cobalt coming out of the ground, because everything will go up exponentially. So the mining sector is trading at ridiculous discounts. I mean, I can't believe that we're even worried about Freeport. I mean, Freeport here at 1036, or many others are trading at a fraction of their enterprise value. Just go out there, acquire them, take a long-term approach, write those cover calls, define your risk, come in with, obviously, this is just cash positions, no margin. Come in there, define your positions, take that revenue, and you're probably, in most situations, you're going to be generating, roughly speaking, 15 to 20% of an ROI if the equity just stays flat, relatively speaking. But you're going to radically reduce your costs. Then if you come in there and you're right out of the money puts, and you look to accumulate on any weakness, it's going to be gold for you. Okay,
John. So excellent presentation of your investment model. How about telling us about your business model? I see that you do training. Do you write a letter? I don't write any present newsletter. I'm going to start a program online webinar just to teach investors, just the everyday mom and dad, how to use options to reduce risk, to help their, many situations it'll be the retirement age. I love being able to help people with their dividend funds so they have lower risk, if not risk eliminated, and increase the revenue coming home. I'm going to start a whole program webinar. It's going to be free of charge, just online, to help what I believe, the investment industry and investors worldwide. Okay, that's a good idea to offer it free, especially millennials can't afford these numbers that I see here. Well, so and if you want them to invest, first they have to, they're saddled with their student loan debt. So this would be, unattainable for them. So kudos.
And I think it's just something that we have to do. I mean, you know, the investment industry has given me a great career, and I'd like to see an entire generation learn how that they can invest in safe, long-term assets and build a legacy and accumulate wealth and preserve it, right?
Right. So I really appreciate you coming in today, John. Great to meet you.
Great to meet you as well.
You're a trading warrior brother of mine, even though you're more of an investor option writer. And people can follow you on Twitter at Renegade Style. So
Thank you
you
very much.
consider what you talked about today as, you know, I would consider it a fairly aggressive, conservative approach rather than speccing with a lot of leverage.
Yeah, it's no
Why did
speculation.
you choose Renegade?
Oh, well, you know, all my approach, you know, this goes back 30 years ago, and everything I've done is believing in understanding numbers, math. And I always make a joke, it's just a math geek life. I'm just a, you know, I had a great discussion with a guy who's an expert in lithium. We were sitting at a cafe.
Oh, I used to have to take that when I was trading big on the floor.
And I used to,
Lithium.
and I was talking to him, I said, there you go. And I said, I'm basically a slide rule quant. And and the kid, he's a young guy looking, he said, no, back before we're using, you know, or those TIs, I was, you know, a slide rule quant doing all my analysis with a slide rule and paper graphs. And I still use a large chalkboard in doing calendar spreads. But, you know, it all comes down to understanding numbers and the prediction of numbers, prediction of commodity prices. And somewhere in around 1983, when I was first studying options, I realized I can try to predict these things all I want, just like anyone else. But no matter what, it's not going to be perfect. But what is going to be perfect is each week, these options will expire with zero premium. In other words, things can go up and go down, but you can actually make money on little movement. And so I looked at that and I said, this is really just another version of time arbitrages, and you might as well scalp it out.
Yeah, isn't it amazing how market makers can pin a price into expiration where there's the most open interest?
That's fascinating, isn't it?
Yeah, see, you didn't think I knew things like that. Anyway, John, great meeting you. I wish you a successful, prosperous, healthy, joyful 2019 for you and your family and all your mentees that you teach. And
well, thank you very much, Dale. Really. It really was a pleasure. I mean, I hate to put it this way, but I just started listening to your show because, you know, yesterday I was so excited to be on. I came on early, but I love your show, and I really look forward to attending and watching it, listening more.
You're always welcome, John, and you may even want to consider becoming a subscriber like many of my other guests have become.
I'm going to.
I mean, great input from the team. This is a team we have here at ForexAnalytix, and I'm happy just to be a spoke in the wheel. So
that's exactly it, isn't it, Dale?
Yeah, so thank you, John. You're now my trading warrior brother, like it or not, and good luck and good hunting, and let's keep in touch.
Thank you very much. Have a wonderful day, and thank you for having me on the show, and I wish your subscribers all the very best, and a Happy New Year.
Thank you so much, John Davies at Renegade Style. That's a wrap for us. See everyone for the NFP tomorrow. NFP stands for no effing problem. So above that, don't just count your pips, count your blessings. Adios, everyone. See you bright and early for the NFP. Thanks again, John.
Thank you.